Hello everyone and welcome back again. So today we are doing the second part of this payback period. So in the first session, I hope it is clear to you, payback period is used to calculate to find out the time which is required to recover the original investment. So for this we have the formula, that is initial investment divided by CFAT per annum. This is the formula for finding out payback period. So earlier we have done two problems on this formula. So today we are going to do two more problems on this. But today CFAT also we need to calculate. The CFAT will not be given in the question. CFAT is cash flows after tax. So here we will focus on this. Rest all is same. When first we need to calculate CFAT if it is not given in the question, that we learn how to find out CFAT if it is not given. Rest, when we will get the CFAT, you just apply the formula. If the CFAT is same for each year, then go with the formula. If it is different for each year, then go with the cumulative CFAT approach. Okay. If you have not seen the previous video, just see that, then come up for this video. So, okay. So here are a few things. This maybe this is looking something tricky. You will feel that there are so many formulas are there, but nothing to worry about it. You just remember one thing. For CFAT we have this profit after tax plus depreciation. If something is after is written, means profit after tax, means from the profit tax is already deducted. If they have given profit before tax, means tax is not deducted from the profit. So before and after, these words you have to understand. If before means before tax, means tax is not deducted. After tax means tax is deducted. Before depreciation means depreciation is not deducted. After depreciation means depreciation is deducted. If before, not deducted. After, deducted. So what we need in CFAT? We need profit after tax, means we need deduction of tax plus depreciation. This we need. So CFAT is profit after tax plus depreciation. For profit after tax, we have to deduct tax from the profit. That is what I told you. And profit after tax also, first we need to, okay, in the question if profit is given, so we have to deduct two things from this profit. First depreciation and then tax. From the profit, when we will deduct these two things, then we will get profit after tax. That is what we need. Then profit after tax plus depreciation, that will be CFAT. This is how we will find out CFAT. Okay. Just remember this. From the profit, we have to deduct two things in the same order. First depreciation we have to deduct, then tax we have to deduct. So we will get PAT, profit after tax. Then add the depreciation. Why? Okay. Here is one thing. Earlier, first we are deducting depreciation, then we are adding depreciation later. Why we are doing this? Just to get the tax benefit. If from the profit we will deduct the depreciation, then we will find out tax, so that amount will be less. So just for this, first we are deducting depreciation. So just remember this. Okay, so we will do problems on it, then you will clearly understand this question. This formulas you will understand. So here the question is, remember the words before and after. A project cost rupees 25 lakh. Cost 25 lakh means initial investment simply we got as 25 lakh. Okay. Then it yields two things only is needed, initial investment and CFAT. Then it yields annually a profit of 5 lakh. So this 5 lakh is, it can be CFAT, but they have given 5 lakh after depreciation, before tax. After depreciation at 15% and before tax at 50%. So from the profit, depreciation is deducted because after they have mentioned. But tax is not deducted before tax they have mentioned. So we will take the profit. That is, profit is given as after depreciation and before tax. That is how profit is given. That is 5 lakh. So this profit, from this profit, I told you for finding CFAT, first we have to deduct depreciation and then tax from the profit. So depreciation is already deducted. Now we have to deduct tax from it. So tax rate is 50%. So 50% of 5 lakh will be 2,50,000. On this 5 lakh, we will calculate 50%. On the profit only, we will calculate. So we will get, after deduction of tax, we will get this amount. So this is profit after tax. This 2,50,000 is profit after tax. For CFAT, if you remember, CFAT is PAT plus depreciation. Now, just add the depreciation here. Depreciation will be calculated at the rate 15% on the initial investment. So initial investment is 25 lakh. So on 25 lakh, calculate this 15%. So after doing the calculation, you will get 3,75,000, correct? Just check the answers. Don't rely on my answer. It may be wrong also. So this 625,000 is CFAT. I hope this is clear to you. So now for payback period, we just need two things, that is initial investment divided by CFAT. So initial investment is 25 lakh, CFAT is 6 lakh 25,000, and we will get how many years? 4 years. So 4 years will be our answer. I hope this calculation is clear to you. They have given profit after depreciation and before tax. Just remember this, from the profit we have to deduct two things, depreciation and tax. So depreciation is already deducted, just tax we have to deduct here. Tax 50% we have deducted. So we got profit after tax. Then profit after tax plus depreciation is what CFAT is. CFAT, how we can find it out? CFAT is just profit after tax plus depreciation. This is how we will find out CFAT. So PAT we got, now add the depreciation. It will be calculated on the initial investment, 15%. So we got this. So just payback period is initial investment divided by CFAT. We got 4 years. I hope it is clear. Now in this question, we'll do one more question here. So they have given CFAT, which was same in each year. Okay. Now in this question, CFAT is different in each year. CFAT is not given. Here also profits they have given. So initial investment is 3 lakh. Initial investment is 3 lakh. Numerator value we got. Okay, one more thing. Here numerator value, here we cannot use the formula because profits are different in each year. So we have to go with the cumulative CFAT approach. So first we need to find out CFAT because they have given profits before depreciation and tax. That means neither depreciation nor tax is deducted from the profit. So from the profits, 5 years profit are given as follows. These are the 5-year profits. So from the profits, we have to deduct the depreciation and then we have to deduct the tax. Okay, one more thing. Here tax rate they have given, but depreciation they have not given. So how we'll find out depreciation? So just take the initial investment, that is 3 lakh, and for how many years the project life is? It is for 5 years. So we will find out depreciation as life of asset is 3 lakh and this is for 5 years. The project life is 5 years. So 3 lakh divided by 5, that will be equal to 60,000. So depreciation is 60,000. I hope it is clear. Now we will prepare a statement. We will prepare a statement, means year we will write, profits we will write. Okay, so 5 years are there here also. So 5 years are there. We will take the profits. First year 90,000, second year 1,10,000, third year 120,000, fourth year is also 120,000, and fifth year is 70,000. So these are the profits given, and these profits are given before depreciation and tax. Now we have to deduct depreciation first. So profit minus depreciation. Depreciation is 60,000. It is same in each year. This we will deduct. 90,000 minus 60,000 will be 30,000. 110 minus 60, 50. 120 minus 60, 60. This also 60. And last year 10. Now depreciation we have deducted. Now we have to deduct tax. So deduct tax. So here we will do from the previous column, that is profit before tax, we will deduct the tax here. Tax rate is 50%. Just find out 50% on these on these profits, you just find out 50% and deduct 30,000. 50% on this is 15,000. So 30 minus 15, this will be 15,000. So this calculation you can do. Just calculate 50% on the profit and deduct. So okay, I hope it is clear. Now CFAT is, this is PAT, this is profit after tax we got. So this column plus depreciation. Again we have to add depreciation here, we will get CFAT. So in each year's amount you just add 60,000. So 75 here, 85, 90, 30 plus 60 also 90, and then 65. Now here we have done calculation only for CFAT. Now the last thing is cumulative CFAT we need to find out. This is the last thing that we will do. So cumulative CFAT, first amount we'll write as it is 75,000. Now 75 plus 85, that will be 160. 160 plus 90, 250. 250 plus 90, 340. 340 plus 65, 4,05,000. Now what we have to see here is, okay, I hope it is clear. Now we have to see this 3 lakh in how much time we can recover. So 3 lakh you cannot, in this cumulative CFAT column you cannot find exact 3 lakh, but up to 3 years you can recover 250,000. How much more we need? So 3 years we will take, and how much more months will we need it? In the 4th year we are getting 90,000, but initial investment was 3 lakh. Up to 250 we recovered, 50,000 more we needed. So in the 4th year we are getting, in the 12 months we are getting 90,000 and we need only 50,000. So that will be equal to 6.666 something. So we'll take it as 7 months. So answer will be 3 years and 7 months. This will be the answer. I hope it is clear. So in payback period, just to see this thing, if CFAT is given or not in the question. If it is not given, so from the CFAT, just from the profits, first deduct the depreciation and then deduct the tax and then add the depreciation. 3 steps. Deduct depreciation, deduct tax, and then add depreciation. And please remember these words, before and after. Whether they have given before depreciation, after tax, before tax, after depreciation, what they have given, just remember this. Before depreciation means depreciation is not deducted. After means it is deducted. So just go through the words. So you have to do these things. Then after finding out CFAT, it is same only. If CFAT is similar in each year, then just go with the formula initial investment varied by CFAT per annum. If it is different in each year, just find out cumulative CFAT and find out in how many years we can recover the original investment. If you are not getting the exact value, just take the years and then how many more months are required. So this is what it is. Thank you.